Bank rate currently stands at 5.25%, where it's been for the last 6 months. Obviously, that's a 16-year high. Interest rates have not been higher than that since the spring of 2008 at the heart of the global financial crisis. We're not expecting a change in the policy rate today, chiefly because inflation remains at 3.2% ahead of the bank's target rate. Meanwhile, wage inflation is running at around 6%, so appreciably higher than the Bank of England would want to see. But clearly, there are expectations that there will be a rate cut in coming months, and I can tell you, as expected, the Bank of England has kept interest rates maintained at 5.25%. The key thing we're looking at for now is the composition of the vote. That was 7-2. Now that's interesting because last time around it was 8-1 in favour of keeping rates on hold. Another member of the Monetary Policy Committee has moved towards cutting interest rates, and that really does tell you that the debate is hotting up inside the Monetary Policy Committee towards a rate cut. In fact, I can tell you earlier this week, Jane, the market was putting a 50% chance on there being a rate cut as soon as next month, whereas most market pricing was fully expecting a rate reduction in August of this year. So that is very interesting. That suggests that the dynamics within the Monetary Policy Committee itself are edging towards an interest rate reduction. Obviously, we get the GDP figures out tomorrow. We're widely expecting the UK to have confirmed that it's emerged from the very shallow recession it entered in the second half of last year. We're fully expecting a return to positive growth in the first 3 months of this year. But in the meantime, it's the interest rate has been kept on hold. The other thing to watch out for, of course, is what the Bank of England Governor Andrew Bailey says. Now, he will be delivering his statement to the market in a press conference at 12:30 this lunchtime. We'll, of course, be bringing you that on Sky News. I'm looking where I can now to see whether I can get any further information on what the Bank of England has said here. Here are the latest minutes, of course. I'll read a bit of this out to you, Jane. It says the committee's projections for activity and inflation set out they imply market implying bank rate declines from 5.25% to 3.25% by the end of the forecast period, with an endpoint of 3.25% in February. The Monetary Policy Committee making clear here recent growth outturns have tended to be stronger in the United States than in the Eurozone. Underlying inflationary pressures in both regions have continued to moderate somewhat since the start of the year, though by less than expected in the United States. And of course, that is critical, Jane, because everyone expected the Federal Reserve in the US to have cut interest rates by at least a couple of times by now at the beginning of the year. Since then, the US economy has proved to be much, much more robust than anyone expected. And that has meant that the Fed have kept rates on hold. And that really gives less cover to institutions like the Bank of England to reduce interest rates. I can tell you other points that the MPC makes here. Following modest weakness last year, UK GDP is expected to have risen by 0.4% in the first quarter of this year and to grow by 0.2% in Q2. That's the current quarter that we're in now, of course. And the MPC goes on to say, the bank goes on to say, despite picking up during the forecast period, demand growth is expected to remain weaker than potential supply growth during most of that period. A margin of economic slack is projected to emerge during 2024 and 2025 and to remain thereafter, in part reflecting the continued restrictive stance of monetary policy. I mean, that feels to me like a bit of pitch rolling from the bank for these interest rate reductions that we expect later on in the year. Now, the bank goes on to say here, with respect to indicators of inflation persistence, services consumer price inflation has declined but remains elevated at 6% in March. Again, that's very, very important because the Bank of England, not only while looking at the headline rate of inflation, CPI, which is obviously mandated to keep at 2%, it's really keeping a weather eye very closely on services inflation because, of course, services makes up 80% of UK GDP. So that is very important. And the bank goes on to say here there remains considerable uncertainty around statistics derived in the ONS labour force survey. Now, going back to what I was saying earlier, Jane, wage inflation in the latest period, which was the end of December last year through to the end of February this year, wage inflation was running at 6%, far, far higher than the bank would want to see. But the bank making the point here that there's been a lot of uncertainty in the markets about the accuracy of some of the labour force data that we're getting from the Office for National Statistics right now. So the MPC addressing this in this statement, it says, based on a broad set of indicators, the MPC judges that the labour market continues to loosen, but it remains relatively tight by historical standards. Annual private sector regular average earnings growth declined to 6% in the 3 months to February, so I just mentioned, but that series tends to be volatile. It says here the MPC remains prepared to adjust monetary policy as warranted by economic data to return inflation to the 2% target sustainably. It will therefore continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including a range of measures. So it's going to keep on review that bank rate has been maintained at the current level. I think after this vote today, Jane, we are moving ever closer to a first interest rate cut from the Bank of England. But Ed Conway will doubtless have more to say on that in just a moment.